Hey, good morning, everyone. I am Mark Phillips from Harvested Financial, and we're here today to look at the markets. Well, it's Wednesday, the 17th of February, and we are coming up hot on the big February expiration. So not only are we coming up hot on the big February expiration, but we also have some really interesting earnings activities going on. So because today is Wednesday, we're talking about butterflies, and butterflies are fantastic for making earnings plays. So I'm going to walk you through some details in what we're looking at here in applied materials. We're going to talk about a couple things. We're going to talk about potentially using an earnings or a butterfly to trade the earnings strategies, but then we're also going to talk about how we price earnings and how we think about the decay of options here. So really quickly, brief rundown of the markets. What do we have going on? Well, SPY is down $2.20. That's 57 basis points. A little bit of a sell-off here. I feel like I've been talking about drift ups every day. So is also down, and of course, all of that means that the VIX is up. So a little bit of air coming out of the markets here today, but we're still early in the session. So let's see what we have in store for us. So I want to talk about, like I said, applied materials. And so the ticker here is AMAT. And what we're looking at is a global semiconductor demand that's driving some strong revenue forecasts here. So looking at AMAT, some of the other headlines that I've got on my radar are shares are up 33% year to date. So we've seen some pretty strong growth. And we've also seen this all comes, I guess, amidst the backdrop of this strong global demand for semiconductors, particularly with the 5G expansion that has been happening recently. So a lot of tailwinds behind this equity name. And so what are we going to think about here in terms of how to trade this going into earnings? So when we think about earnings trades, it's one of the most discrete known events in an options life or in an equities life. 4 times a year, companies have to go out and they have to announce their results. They have to describe what's going on. They have to answer investor questions. This is where they're giving indications about what future projects might look like. So it's a very known event. And what that means, it means there's a very high concentration of expected variance on that day. So when we talk about implied volatility with an option, we think about how that option is going to move approximately a certain amount every given day. So in applied materials case, the vol is trading in the back months around the 50-ish level. So in a 50-ish vol stock, you'd expect that to move about 3% a day. Now, we know that the day that they announce earnings, which is actually going to be tomorrow after the close, we're going to expect a bigger move than just that regular 3% a day move. So it creates some interesting decay factors when we're looking at the options going into expiration. So earnings is Thursday after the close. The big February expiration is Friday. So if we're looking at the February options, we're going to see some really curious behavior. So I'm actually going to show a little bit of how the theoretical straddle price will decay here in an earnings versus non-earnings situation. So the green is going to be the earnings situation, and the darker green, I should say, and the lighter green is going to be the non-earnings situation. So that non-earnings situation, we see a gradual slope down. So, that's certainly not linear. Theta does not decay linearly in the option space. It does, most of it does come out at the very end of the time there. But compare that to the earnings, which is the higher, bolder, darker green line, and we see that the straddle price here does not move much throughout the first 9 days. Day 9 would be the earnings day right before that expiration on day 10, where after the news is announced on day 9, we're going to see that straddle value just absolutely cave in. So, but the important thing to highlight here is that over the first 9 days, while in a non-earning situation, the straddle price will continue to decay, in an earnings situation, that's not going to decay as rapidly because we know the variance is going to happen on Thursday afternoon. It's not randomly distributed throughout the lifetime of the option with a meaningful amount coming out every day. We know that that's happening, and so the straddle price needs to maintain a certain level of value, commensurate with the expected move on that day. So let's take a look at some of the markets here, and we'll see exactly what I mean. So when I'm looking at applied materials, I'm looking at this 2 days to expiration, February 19th. February 19th is that serial expiration. Going to be a lot of volume and liquidity at this time. But looking at the straddle, the straddle at the 116 level right now is trading around $6.80. So given that expected move, just over the course of the next it's really 3 full trading days, 2 3/4 trading days since we just opened. But over the course of the next 2 3/4 trading days, we expect this stock to move about $6.70 right now. So let's put on a butterfly that can take advantage of this. And I like butterflies. We like butterflies at Harvested Financial because they are defined risk. So we talk a lot about straddles in terms of what the expected move is. I just did the arithmetic on what the 116 was, but we want defined risk here because we don't want to be totally exposed to a potential downside or upside surprise. So if I sell 2 of the 116s and think about how much or what that straddle price is going to mean in terms of overall moves. So if I want to target about a $6 move, $6.50 move, I'm going to go up $3. Actually, it doesn't look like I can go up to $3. So I'm going to go up $4 because this is going to totally encompass that move. I'm going to have the 120, 112. So the 112, 116, 120 butterfly here. Looks a little bit broken wing just because of the way the strikes are listed. And actually, they listed some of these new ones, the 14s, 15s, 17s, 18s. I believe those were newly listed today. So if I take a look at the what if, I'll move myself down here and we can see what the what if looks like. This is going to be our classic butterfly graph here where we see the max profit zone is going to be right in the middle if it does sit at that 116. Now this is a short volatility trade, so we're betting that AMAT, a lot of the news is out. When I talked about some of those headlines, much of this has already been known. So absent a big surprise, this type of trade is going to benefit if volatility comes in after earnings and the high price of that earnings straddle that's about to completely lose its value on Friday is going to crater in and look a lot more like AMAT in normal days. So AMAT in normal days moves about 3% a day. That straddle's expecting over a 7% move. So where we make our money here, this straddle, this butterfly, we're gonna enter into for only about a 30-cent debit. Now these markets are a little bit wide here overall, so you've got to be careful about your execution. But this looks like it's trading at about a 30-cent debit right now, which is great because that means it's a relatively cheap debit defined risk play. And if we get that off for 30 cents, the most that can be worth is $4, which is the leg length. So we have potentially up to $370 if we get it for 30 cents, depending on where that execution lies. You could make up to $3.70 for every 30 cents that you laid down. Of course, with the options multiplier, that's $30 and $370. Our profit zone is going to be 30 cents inside each of those different legs. So with this long butterfly trade that you're going into AMAT earnings with, if you take the 116 and the 112 and the 120 levels and add 30 cents, this will be profitable from 112.30 all the way up to 119.70. So you have a very wide range where this could potentially make money, of course, with that max value of $3.70 if AMAT sits right here at $116. So really interesting things happening with options around expiration, especially earnings around expiration, and thinking about how that straddle decays and thinking about where that's pricing the expected move in the underlying equity. So earning strategies like this are a great way to get an intro to equity options trading. And overall, while this is one play, typically this is the type of play that you want to execute systematically and over time. And that's what Harvested Financial excels at, is the systematic implementation of option strategies. Whether they're earning strategies, whether they're buy rights, whether they're collars, staying exposed to the options markets over time is one of the best ways to continue to profit from them. So it's not just about one trade in AMAT and one single earning structure. This is simply an example of how you could start to compose a different basket of these different ones, making plays on names that have earnings in a given short period of time, isolating that volatility factor. So think about putting a lot of different eggs out there when you're thinking about entering into these butterfly strategies. They're relatively cheap, like we saw. This is only 30 cents to make a play here. So you can spread that around across a number of different names to kind of diversify your exposure and hopefully capture some winners across the variety of different names that you've put on. So like I said, think about diversifying these earning strategies and spreading your eggs across a number of different places. It's a great way to capture opportunity around earnings using options. So Harvested Financial is here every single morning talking about these types of opportunities. Butterflies are for Wednesdays, and we will be here on the Daily Bread every morning talking about a different type of option strategy. So be sure to tune in, 8:35 Central, 9:35 Eastern. You can also check us out on our Twitter at harvested_DAFE, because derivatives are for everyone.